Hey everyone, welcome back to Corporate Decoder, the place where we decode the truth behind corporate filings. Today we're going to dissect a filing from Apple iSports Group Inc. And let me tell you, this one is all about securing the future, or at least trying to write. Alright, so what's happening here is Apple iSports Group Inc. is reporting a significant event on August 5th, 2025. Think of this as a big announcement confirming a new financial arrangement that could really shape the company's path. So the core of this filing is a deal. A company called LDA Capital Group LLC is going to invest up to a massive $25 million into Apple one-time injection of cash. It's set up so the company can ask for money anytime within that 3-year window. Now here's where it gets a bit technical, but stick with me. The company can request funds for specific amounts, but there are rules. The amount they can ask for is tied to how much of their stock is usually traded on any given day. The idea is to not disrupt the market too much when they sell new shares. LDA Capital Group can choose to buy only half of what Apple iSports asks for, or even up to double what they request. It gives LDA a lot of flexibility. And here's a crucial detail about the price. LDA Capital Group will buy the company's stock at a discount. Specifically, it's 90% of the average stock price over a certain period. This means Apple Watts Group is essentially selling its stock at a lower price than what it might be trading for on the open market. This is pretty common when companies need funding and are looking for investors who are willing to commit capital for future growth. Now, for the upfront cost to secure this $25 million investment, Apple iSports Group had to pay LDA Capital Group a commitment fee. This fee is 2% of that total $25 million limit, which is a cool $500,000 just for signing on. They also paid an expense fee of $25,000. On top of the cash and fees, Apple iSports Group also gave LDA Capital Group a warrant. Think of a warrant like an option to buy stock. In this case, LDA got the right to buy over 7.6 million shares at $7.78. Significant amount of stock, and the price can even adjust over time. This is basically giving LDA another way to profit if the company's stock price goes up significantly. There's also a limit on how much stock LDA Capital can own. They can't end up owning more than 4.99% of Apple iSports Group's total outstanding shares through this deal. This is a common regulatory safeguard to avoid certain ownership thresholds. As for why this deal is happening without all the typical federal registration hurdles, the company is relying on an exemption from registration called Section 4A2 and Regulation D. This is generally for private placements of securities, meaning they aren't offering this to the general public directly, but to specific qualified investors like LDA Capital Group. Now, the really detailed legal documents are filed as exhibits. You can find the main agreement, the common stock purchase agreement, the warrant itself, and even a registration rights agreement, which is about how both parties will handle future stock registrations if needed. And finally, the report is signed off by Joe Martinez, the Chief Executive Officer of Apple iSports Group. This confirms that the company officially acknowledges and is moving forward with this important transaction. So what does this all mean for Apple iSports Group? They've secured a significant potential funding source. This $25 million facility gives them a lot of flexibility to raise capital as needed over the next 3 years. The discount on the stock purchase and the warrant are the price they are paying for this access to capital. It's a classic strategy for companies that need cash to fund growth or operations but might not be able to secure traditional bank loans easily. The key here will be how they use this capital. Are they investing in new products, expanding their market reach, or covering existing operational costs? The company is essentially betting on future growth to make this funding arrangement pay off. It's a strong move to ensure they have the resources to execute their strategy, but it comes with the dilution of existing operational costs. The company is essentially betting on future growth to make this funding arrangement pay off. It's a strong move to ensure they have the resources to execute their strategy, but it comes with the dilution of existing shareholders. As new shares are issued and the cost of that warrant, we'll be watching closely to see how this plays out and if this funding translates. What's your take on this kind of funding arrangement? Do you think it's a smart move or a sign of underlying weakness? Let us know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more dives into corporate financial filings. Don't forget to join our Discord community linked in the description for even more insights and discussions. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.